So far in 2025, we are seeing massive changes to the US economy that are directly impacting your wallet, from areas like the One Big Beautiful Bill with impacts like no tax on tips, or the Fed cutting interest rates, insurance costs being on the rise, and Social Security being at risk. But before we get started, my name is Sully, and all I ask is if you do find value from this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over the One Big Beautiful Bill. For those that don't know, the One Big Beautiful Bill was just recently signed by President Donald Trump on July 4th of 2025, with the goal to provide tax incentives for everyday Americans and boost the overall US economy. And so the White House specifically states on their site that this bill contains the largest tax cut in history for middle and working class Americans, which will most benefit workers and families making less than $50,000 per year. The bill also includes no tax on tips, where the IRS states this is effective through 2028, and that qualified tips are voluntary cash or charged tips received from customers or through tip sharing, where the maximum annual deduction is $25,000, and the deduction phases out of taxpayers with modified adjusted gross incomes over $150,000, $300,000 for those if you file jointly. The bill also contains no tax on overtime, which is also effective through 2028, where individuals who receive qualified overtime compensation may deduct the pay that exceeds their regular rate of pay. The maximum annual deduction is $12,500 if filing single, and then $25,000 for those that are joint, and the same concept applies where it phases out if you pass certain income thresholds. The White House also mentions no tax on Social Security, where it stated 88% of all seniors who receive Social Security will pay no tax on their benefits, and the reason for this is because of the new senior deduction that has been added to seniors that can deduct even more from their taxes. And so this deduction for seniors is also effective through the year of 2028 for those of the age of 65 or older that are now able to claim the additional deduction of $6,000, which is per individual, and a married couple can deduct $12,000. Besides that, the One Big Bill also has $12.5 billion going to the Federal Aviation Administration, the FAA, to fund air traffic control modernization that includes acquisition, construction, sustainment, and improvement of facilities and equipment necessary to improve or maintain aviation safety. Then there is a permanent increase to the child tax credit for more than 40 million families, but there is a minimum that individuals or families must earn in order to qualify. They're also planning to finish the wall and hire thousands of officers and patrol agents, as well as offering a tax deduction on Made in America vehicles with the auto loan interest, which is effective through the year of 2028, where individuals may deduct interest paid on a loan used to purchase a qualified vehicle, provided the vehicle is purchased for personal use and meets other criteria. The maximum annual deduction here is $10,000 that phases out for taxpayers earning over $100,000 per year, or $200,000 if joint filing. For this to qualify for the deduction, the interest must be paid on a loan that is originated after December 31st of the year 2024. Used vehicles do not qualify, it cannot be for business or commercial use, and you must have a secured lien on the vehicle. And so qualified vehicles may be a car, minivan, van, SUV, truck, motorcycle with a gross vehicle weight rating of less than 14,000 pounds. The bill also contains protection for 2 million family farms from double taxation, and they are working to strengthen Medicaid by eliminating waste, fraud, abuse, and blocking illegal immigrants from receiving Medicaid, and are aiming to modernize the military. Aside from that, another area to touch on, especially for high-income earners, is when it comes to state and local tax deductions, also known as the SALT cap, which limits the amount taxpayers could deduct for state and local taxes on their federal returns. The limits are temporarily increasing from $10,000 all the way up to $40,000, and increase year over year until 2030, where it's planned to drop back down to $10,000. But an area that has impacted many was reported by CNBC that says 61% of college students say they will be impacted by Trump's Big Beautiful Bill. And so the new bill is bringing in new borrowing limits and reducing the number of repayment plan options for federal student loan borrowers looking to take out loans on and after July 1st of 2026, which it's also eliminating Grad Plus loans for students that are seeking advanced degrees after that date. Supposedly, over a third of respondents in their survey said they're canceling plans to further their education in response to policy changes, Others are considering school abroad or joining the military to help fund their education. Currently, grad and professional students like medical and law school can borrow a max of $138,000 over the course of their studies, including any loans as an undergrad, where under the new legislation, graduate students can borrow up to $100,000 on top of their undergrad loans, while professional students can take up to $200,000. And below, if you want to pause the video, you can see the exact changes that have occurred for federal student loan limits from the big beautiful bill. All in all, there have been a ton of changes recently, and certain laws may affect you more than others, but being aware of them could at least help you make wiser financial decisions. Knowing that, let's now go over interest rates and the potential cuts we could see ahead. Now, since March of 2022, the Fed's target funds rate was near rock bottom between 1/4 to 0.5%, where throughout 2022 to 2023, they had many rate hikes to fight inflation that brought the rate between 5.25% to 5.5%. Needless to say, borrowing became very costly and other economic impacts have come up, but the overall stock market long term has done very well for investors. But as far as the interest rates, recently the Fed has placed a few rate cuts, and even though the announcements are always changing, Chairman of the Federal Reserve Jerome Powell just recently noted that the Fed may need to cut rates, saying that risks to the job market were rising, but also noting inflation remained a threat, making the decision not set in stone. And with potential interest rate cuts ahead, JP Morgan states that it could bring the target range for the policy rate to 3.25% to 3.5% by the end of the first quarter of 2026, which we are currently seeing the Fed rate around 4.3%, and understand that the Fed lowers interest rates to stimulate economic growth, where they raise interest rates if there is too much growth. Because of that, their target inflation rate that they seek to achieve is 2%. And according to Bankrate, currently the annual inflation rate is sitting at 2.7%, just higher than the Fed's target. All in all, a potential rate cut in the future simply means that things like buying a car or buying a home will become cheaper, but the con is that it also follows the same path with your savings. So if you have a high yield savings account, the interest that you're going to be earning is likely to decline as well. Which I will say, if you want to get started with a new high yield savings account, I'll have a direct link in the description below to some of the top ones. But knowing that, let's now go over insurance costs that are rising. The US Department of Treasury posted this year that the average homeowner's insurance premiums per policy increased 8.7% faster than the rate of inflation in 2018 to 2022, where some consumers faced substantially larger premium increases than the national average. And homeowners in communities affected by substantial weather events are paying far more than those elsewhere. Personally, I encountered this with insurance on a home I had in Florida that started initially around $1,500 a year in 2019, but by 2024, after a few hurricanes hit, the prices rose to almost $4,000. CNBC also shows that the average rate has increased from $2,600 in 2021 to $3,300 in 2024, which is a 24% increase and is more than twice as fast as the rate of inflation that occurred in that time period. And of the states with the biggest increases in only 4 years of time, we have Utah up 59%, then Illinois, Arizona, Pennsylvania, and then Nebraska at the top. And then you can see others if you want to compare with your own. But interestingly enough, West Virginia's went down 24%. Not just that, but experts state that health insurance prices are likely to rise next year, where Vice President of KFF says we're in a period of uncertainty in every health insurance market right now, which is something we haven't seen in a long time. PBS starts off their article by stating that price prescriptions and nagging medical costs are swamping some insurers and employers right now, where patients may start paying for it next year. But knowing that about insurance, let's finish this off and talk about how Social Security is at risk. For those that don't know, the reserves for Social Security are expected to decline, and the so-called Go Broke Day, which is the date Social Security will no longer have enough funds to pay the full benefits, that has moved up to 2034 instead of last year's estimate of 2035. After that point, Social Security would only be able to pay 81% of the benefits. Currently, Social Security benefits serve as the financial backbone for millions of American retirees, with the average monthly benefit sitting at just under $2,000. For millions, these payments represent a significant portion of their total retirement income, making every dollar crucial for maintaining their standard of living. And with inflation remaining high, these funds may even be more crucial for retirees who are facing higher costs at the grocery store, fuel pump, and pretty much anywhere else. These benefits are stated to lift nearly 17 million older adults out of poverty. And I mention all this so you're aware that Social Security is not something to rely on, and the expected amounts in the future are not guaranteed. In fact, Merrill Lynch shows that 60% of 18 to 44-year-olds doubt Social Security will be there when they are ready to retire. And a quote I liked here was that for young savers especially, the money you personally save and invest is likely to continue playing a larger role in determining your financial security in retirement than Social Security. So whether it be the impact from the one big beautiful bill, the Fed cutting interest rates, rising insurance costs, and the uncertainty for the future of Social Security, it's clear that things are drastically changing over time and coming much sooner than you may think. All in all, my key takeaway here is to control what you can control, because if you can properly save and invest for your future, you are less likely to rely or be impacted from big changes that could come up. This is a huge reason why I'm in the process of building my new startup, and once that's officially released, I'll have it linked in the description below if you want to check it out. Now, if you found value in this video, I'm going to leave other videos and resources that I think you may find helpful in the description below. And if you want to get started with a new high-yield savings account or investing platform, I'll have direct links to some of my favorite ones below as well. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.